Amit Ramani, CMD of Awfis Space Solutions. Amit, hi, Tamanna here. How are you doing? And good to chat with you again. Yeah.
Same here.
Let's start with this change in key managerial position with the CFO. What has happened there?
So Tamanna, obviously, transitions are part of our business continuity. Sumit Rochlani joins us. It's Ghar Wapsi. He was with us for almost 2.5 years during some of our toughest times during COVID. And he's coming back, 15 years plus of experience, can hit the ground running, has the complete experience of the business. In fact, set up the business to a level where we in 2024 went in public, right? So I think that's great from that standpoint. So we don't see any challenge because the finance team is well structured. Our foundation, our overall teams, including our CEO, Sumit Lakhani, our COO, Manu Dheer, our head of real estate, Dipayan, have been there from the start with us. So I think this is part of the transition, and I don't see any challenges going forward. The financial discipline that we have maintained, the governance levels that we are strong in we'll continue to be strong in those areas.
Sure. What is the reason, though, that Mr. Dugar is moving on?
It's better personal opportunities. I think he was the one who took us public, and he was the one who drove us to that, and clearly he is looking for opportunities for his personal growth. So no other reason.
Okay, I'm going to take a cue from my research analyst, and very good morning to you. Thanks so much for taking the time, and wish you a happy new year. Alex here. So I want to ask about the design and build business that you are moving effectively to a wholly owned subsidiary. As my research analyst pointed out, it contributed about 23% of your revenue in FY25. I'm just trying to understand what the implications will be on the margin and the bottom line heading into FY26.
So overall, at the holdco level, it's a 100% owned subsidiary, right? So when you look at the overall financials, there would not be much of a difference. But now you will be able to clearly see the co-working managed office business and its margins, EBITDA and PBT, as well as in the design build business, you will be able to clearly see the margin profile, right? Both businesses are complementary. Clearly, I think I've said it in the past that the design build business is a key ingredient to a successful co-working and managed office business. Clearly, quality of design and the speed of execution are key differentiators. And I think with this, the leadership of the design build business under Awfis Transform Pvt Ltd will be able to focus on not just delivering for Office, but also for third-party design and build solution for other companies. Today, out of the overall business, about half of it comes from our own centers that we build in a managed aggregation format, and the other half comes from what is an independent third-party design build opportunities. 200 odd crores is what we spend. So the subsidiary itself, day one, would be a 500 crore revenue business. And we have built that in the last 3 years, one of the fastest probably ever built in the country in the design build space. Very few companies have been able to build a brand. We believe that ATPL will be one of the first ones to build a very strong design and build engine. And we feel that like the global markets where there have been multiple companies that have built a strong brand, we will be one of the first ones to build the largest design and build company and one of the strongest brands in the country, just like we have done with Office.
Good morning, Heer. Also, you've reaffirmed a 30% revenue growth target for FY26, aiming for 1,600 odd crores. Which micro markets or client segments will drive this growth? And to add to it, the roadmap for scaling to higher margins of 25 to 30% relative to the traditional seat rentals.
So clearly, as it's been there out in the market that GCCs are driving a large portion of the growth. 50 to 60% of flex growth over the next 3 to 4 years is going to come from essentially GCCs. We are very, very strong in that area. On the first time GCCs that came to India, almost 10 plus of them we service today, eBay, Meltwater, many others. We do integrated offerings to them. And I think as been claimed by a couple of reports that have come in recent times, we will grow, the flex industry will grow almost 3 times its size, from about 2 billion to about 6 billion on the back of the GCC growth. We are very strong in that area. As I said, we today, 25 to 30 GCCs are being added every quarter, and we hope to take at least 25% of that market share towards our growth. Second, you mentioned about the high margin services. We set up these services at independent verticals last year, which was the platform approach that we took. We set up Office Cafe for our food and beverage cafeteria management. We set up Office Tech Labs for our IT solutioning. We set up Ecos Mobility transportation solutions in their partnership. We also set up essentially Frame by Office, which is our furniture business. All of these verticals will deliver integrated solutions to not just GCCs, but large enterprises. These come with higher margin. And as our portfolio stabilizes with almost 3,500 plus client companies that reside with us, our opportunity to offer is multifold in all of these areas to them.
Understood. Amit, thanks so much for taking the time, and look forward to speaking to you after the Q3 numbers. I think a lot of the numbers we'll be able to talk to you in more detail at that point. But thanks so much for taking the time.